In this video, I am going to discuss about gearing ratios. Companies can finance their business operations by debt and equity. Most common type of debt is bank loans. Issuing shares is considered as equity. The financial gearing ratio is the degree to which the company's operations are funded by debt financing. A high financial gearing ratio indicates that the company has a significant amount of debt relative to its equity, which can be risky as it makes the company more vulnerable to economic downturns or changes in interest rates. On the other hand, a low gearing ratio suggests that the company is primarily financed through equity and has a lower risk of default. 50% of financial gearing is generally acceptable for a business. This means if the gearing ratio is 50% or less than 50%, it is an acceptable level. If the gearing ratio is more than 50%, it will be more riskier to the company. This is how we can calculate the financial gearing ratio. We have to consider the debt over debt plus equity multiplied by 100%. Under debt, we are only consider the long-term debt. It is important to remember that do not consider current liabilities or short-term debt when it comes to calculating the financial gearing ratio. Only consider the long-term debt or long-term loans. Equity is equal to share capital plus retained earnings plus reserves. Higher the financial gearing ratio, higher the risk will be. Now let's do this example. We have to calculate the financial gearing ratio, which is equal to debt over debt plus equity multiplied by 100%. Now let's identify what are the debt amounts in order to calculate the financial gearing ratio. Remember that we only consider the long-term loans or long-term debts. We do not consider the current liabilities or short-term debt. So this is the long-term loan. We consider this as a debt and they have given us the payable amount. This is a current liability. So we do not consider this amount in order to calculate the financial gearing ratio, and they have given us the bank overdraft. This is a short-term debt. We do not consider short-term debt under financial gearing calculation. So this is irrelevant. So the debt is equal to 150,000. So again the debt amount plus equity. Equity is equal to share capital, retained earnings and reserves. So they have given us the share capital and retained earnings. They have not given us any value for reserves. So we only consider the share capital and retained earnings for the equity amount. So the financial gearing ratio for this company is equal to 14.7%. This is an acceptable level because this is below than 50%. This means there is 14.7% of debt in the capital structure of the company. The rest of the capital structure consists of equity. Now let's discuss about interest coverage ratio. This is also known as interest cover ratio. Interest coverage ratio measures a company's ability to pay the interest on its outstanding debt obligations. It indicates the number of times a company's operating income can cover its interest expenses. This is not a percentage value, this is a decimal value. A higher interest coverage ratio indicates that a company has a greater ability to meet its debt obligations, while a lower ratio may suggest that a company is at higher risk of default. So, higher the interest coverage ratio, better. This is how we can calculate the interest coverage ratio. Operating profit divided by the interest cost. Remember that this is the interest expense, not the interest rate. We have to calculate the interest expense in order to calculate the interest coverage ratio. Do not use the interest rate as it is. As now you know, operating profit is also known as profit before interest and tax, and it is also known as earnings before interest and tax. We can calculate the operating profit by deducting the operating expenses by gross profit. We can also calculate it backwards by using the net profit. So operating profit is equal to net profit plus tax plus interest cost. Interest cost can be calculated as long-term debt multiplied by the interest rate. Higher the interest cover, lower the risk. Now let's do this example. We have to calculate the interest cover. Interest cover is equal to operating profit divided by interest cost. What is the operating profit? They have given us the gross profit, operating expenses. So we can deduct the operating expenses from the gross profit. This will give us the operating profit. What is the interest cost? They have not given us the interest cost directly, so we have to calculate the interest cost, which is equal to long-term loan, which is 150,000 multiplied by the interest rate, which is 7%. So the interest cost is equal to 150,000 multiplied by 7%. 7% we have to convert this value into decimal value, so divided by 100. So the interest cost is equal to 105,000. So the interest cover is equal to 0.248. Let's round it off to 0.25. This interest cover is unacceptable. At least the interest cover should be more than 1. Thank you for watching. See you in the next video.